Hi everyone and welcome to Brickflow's Industry Insights. For those that haven't seen it before, it's a monthly roundup of the common trends and conversations we're having with property developers, brokers, agents and lenders every day to give you a good feel for the current market sentiment. First up this month is interest rates. The big news is where are interest rates going? At the moment it's up and rapidly. As we all know, a big reason for our inflation being so high was due to energy prices. The government's intervention in these markets by capping the unit price of energy was much needed. It had a positive effect on inflation forecasts by bringing those forecasts down. However, some of that good work was undone almost immediately by Kamikaze Kwarteng's quite unexpected abolition of the 45p tax rate in the mini budget, alongside many other unfunded tax cuts. This caused a further loss of confidence in UK PLC and sterling weakened. Weak sterling is good for exports as it makes our goods cheaper, but the UK is traditionally a net importer, meaning we import more than we export. So now the goods we import are more expensive, inflation forecasts will rise again. The government has now U-turned on the 45p tax cut, which along with Wednesday's intervention by the Bank of England to shore up the gilt markets has provided some well-needed respite, and the pound has rallied. But this isn't over yet. How high will interest rates go? Well, that all depends on how stubborn our inflation is. An accelerated interest rate rise now, together with ongoing deflationary macro events like falling fuel prices, will hopefully do the trick. But in the short term, an indecisive government that won't publish the workings behind its budgetary sums doesn't help, as it further undermines market confidence and the international community's confidence in our government. It's a sticky situation which is almost all of the government's own making. Anyway, current futures are suggesting interest rates could be somewhere between 5% and 6% by summer next year, which is a very scary thought. However, I have been speaking to some contacts who trade bonds and gilts and also done some wider reading, and there does seem to be a consensus in the market that rates could rise quickly but also fall quickly once inflation has been brought under control. In a recession, typically central banks will cut interest rates, but the Bank of England didn't have that option as our rates were already so low. So by increasing rates decisively now and bringing inflation under control quicker, hopefully the Bank of England has somewhere to go next year when economic stimulus is needed. One reason why this view makes sense to me is that you have a lot of mortgage borrowers with debt they can only just afford at record low fixed rates currently. If rates stay too high for too long, then the number of fixed rate mortgages that matures grows and the number of people that can no longer afford their mortgage is amplified, and effectively the whole housing market collapses. So one just has to hope that the Bank of England is too smart to let that happen. Anyway, so how is all of this interest rate volatility affecting development finance? Well, the good news is that lending appetite remains strong so far. There's been very little change in loan to cost or loan to GDP metrics in the market. The big change, of course, has been on pricing. Brickflow now has 42 development finance lenders on the platform, and prior to the recent rate rises, more than 20 of those offered fixed rates. Now it is around 10 lenders that offer fixed rates, so that gives you some idea of the decline. As rates continue to rise, the number of fixed rate lenders will continue to fall. So if you do have a pipeline scheme and you want to secure fixed rate money, then move now. Gone are the days, I think, where borrowers can only speak to one or a handful of lenders. There is just too big a disparity in the market at the moment. We have specialist development lenders lending at 65 or 70% loan to GDV on a fixed rate basis. We then have some banks and challenger banks lending at lower loan to GDVs, say 60%, offering the same rate, but they're on a variable rate. So as the base rate moves, then their rates will go up as well. So if you're not shopping around, then quite frankly, you have more money in sense, because the pace of change is frighteningly quick. So please do shop around. A quick good news story: we saved the developer £254,000 last week in interest charges on one transaction. The borrower had an offer in hand. Our software was able to identify a better solution in 2 minutes, and it made him a huge saving. So if you're looking for finance, head to brickflow.com, search the market instantly. Not only will you save a lot of time, you could also save a lot of money. Thanks for now.